Lesson 4, Asset Allocation. By the end of this lesson, students should be able to calculate the expected return and standard deviation for a portfolio consisting of multiple risky assets and a risk-free asset, describe the capital allocation line and reward to variability ratio, and interpret utility scores and indifference curve data. In this lesson, you will examine the extremely important topic of capital allocation and the asset allocation decision. To demonstrate just how important the asset allocation is, let's take a close look at the 1991 study by Brinson, Singer, and Biebauer. The authors of this study examined a number of factors to try and determine what drove portfolio performance. The astounding results were that asset allocation, which categories of assets you invest in, account for 91% of performance, while the specific security selected and market timing accounted for only 4.6% and 1.8% respectively. All other factors accounted for only 2.1%. The results really hit a chord with the financial advisory community and investors alike. The capital allocation decision involves choosing and allocating wealth among broad investment classes. In Lesson 1 of this course, you learned about capital market assets, for example, stocks and bonds, and money market assets, including U.S. T-bills. Real assets, for example, real estate, commodities, and collectibles like art, are also available asset categories to the prudent investor. The financial advisor is focused on the risk-return profile of an asset category. As you discovered earlier in this module, it makes sense to combine risky assets that aren't perfectly correlated. By doing this, you are able to achieve a higher level of expected return for a given level of risk. On this chart, you see some historical data that was collected by Ibis and Associates. Look carefully at the risk-return profile, and you will confirm that higher risk is associated with higher return categories. Based on a correlation analysis by Ibis and Associates of historical annual returns during a 68-year span, the following asset category correlations were found. The large cap, small cap stock correlation coefficient is 0.81. The large cap long-term corporate bond correlation coefficient is 0.22. The large cap stock long-term government bond correlation coefficient is 0.14. The intermediate bond large cap stock correlation coefficient is 0.06, and the large cap stock U.S. Treasury bill correlation coefficient is minus 0.05%. While most of these financial assets are positively correlated, they will still reduce overall portfolio risk because they are not perfectly correlated. This graphic from Morgan Stanley Capital International describes the risk-return relationship between various indexes in an interesting way. The returns are for a 48-year period. As an advisor, you do look at historical returns because that information helps you and your clients make important allocation decisions. However, you do have to ask some important questions. Will the next 5 or 10 years of capital market returns and volatility mirror what has happened in the past? Has anything changed? Should recent returns be weighted? As you continue this online investments course, you will read about market efficiency, portfolio management, and top-down versus bottom-up investing. These and other subjects may help you to understand some of these important questions about how to assess historical risk and return data and how to create your own expectations. This graphic, along with several other interesting presentations can be accessed at the link shown on this page. The capital allocation decision, in the broadest sense, starts with how much of one's assets to place in risk-free assets and how much to place in risky assets. Up to this point in the lesson, the risky asset was defined as a single asset. What if the risky component included more than one risky asset? For example, you could hold a risk component, for example, 2, 3, 4, or more risky assets, and a risk-free component in your portfolio. In the risky component, you could have a portfolio of stocks and bonds, and in the risk-free component, you could hold U.S. Treasury T-bills. Let's look at a scenario by considering the following portfolio. In this example, 50% of total assets are placed into the risky asset, where this 50% is diversified 60% to stocks and 40% to bonds, and the other 50% of total assets is placed in risk-free T-bills. If you continue reallocating total portfolio assets between the risky asset and the risk-free asset, while still holding the stock-bond allocation constant, you could solve for and plot out the expected return and standard deviation of each risk-free combination. The scatter plot of expected returns versus standard deviation will result in a linear relationship, similar to the graphic displayed on this slide. Obviously, the slope would change depending upon the inputs. However, a linear relationship would result. That linear relationship is referred to as the capital allocation line. Given historical return and volatility data, an investor could expect to earn a return consistent with the level of risk assumed. And that level of risk is a function of how much of the portfolio is put into the risky asset versus the risk-free portfolio. Let's work through a capital asset line example in order to verify this observation. In this example, there's a risky portfolio and a risk-free portfolio. The risky portfolio holds 60% in large cap stocks and 40% in long-term government bonds. The risk-free portfolio has 100% of assets invested in U.S. Treasury bills. The expected return, standard deviation, and correlation data is provided as large cap stocks with an expected return of 12.5% and a standard deviation of 20.4%. Long-term government bonds with an expected return of 6.0% and a standard deviation of 8.7%, correlation 0.22. And U.S. T-bills with an expected return of 3.8% and 0% standard deviation. The expected return of the risky portfolio is the weighted expected return of the stock component plus the weighted expected return of the bond component. Therefore, the risky portfolio has an expected return of 60% times the stock expectation of 12.5% plus 40% times the bond expectation of 6%. Doing the math, you get an expected portfolio return for the risky asset of 9.9%. To calculate the standard deviation of the risky portfolio, you will use the standard deviation formula for a two-asset portfolio. Inputting the weights, 60% weighting for stocks, 40% weighting for bonds, the standard deviation for the large cap stock, 0.204, and for the bond, 0.0870, and using the correlation coefficient, 0.22, to solve for the covariance, you discover that the standard deviation is 13.44%. But let's take a moment to check these calculations. The first term, the weighted variance of the stock component, is 0.6 squared times 0.2040 squared, or 1.5%. The weighted variance of the bond component is 0.4 squared times 0.0870 squared, or 0.12%. The third term, 2 times the weight of the stock times the weight of the bond times the covariance, is a little more involved because you have to first solve for covariance. You learned last lesson that the covariance is equal to the correlation coefficient times the standard deviation of the one asset times the standard deviation of the second asset. Rho times standard deviation of stock times the standard deviation of the bond. Inputting the data, you find that the covariance is equal to 0.22 times 0.2040 times 0.0870, or 0.0039. With the covariance calculated, you can easily solve the third term needed. 2 times 0.6 times 0.4 times 0.0039, which equals 0.0019. Adding these components gives you a portfolio variance of 1.81%. Therefore, the standard deviation, or square root of the variance, is equal to 13.44%. On this table, you see the expected returns based on changing allocations to risky versus risk-free assets. For example, 90% going to the risky asset, 10% going to the risk-free, 80-20, 70-30, etc. The highest return is expected when the greatest percentage is allocated to the risky asset. The lowest return is expected when the greatest percentage is allocated to the risk-free asset. Similar to last lesson, when you examine the standard deviation of a risky asset and a risk-free asset, you find that the standard deviation of this portfolio is just the weighted standard deviation of the risky asset. That is because the standard deviation of the risk-free asset is 0. That means that the third component in this formula for standard deviation, 2 times the weight of A times the weight of B times the covariance of AB, also becomes 0. Why? Because covariance is equal to the correlation coefficient times the standard deviation of the risky asset times the standard deviation of the risk-free asset. The standard deviation of the T-bill, as you know, is 0. Now it is quite easy to calculate the expected standard deviation of the overall risky, risk-free portfolio for all the different allocation percentages. On this table, you see the standard deviations based on changing allocation to risky versus risk-free asset. For example, 90% to the risky asset, 10% to the risk-free asset, 80-20, 70-30, etc. Consistent with what you would expect, the highest standard deviation is expected when the greatest percentage is allocated to the risky asset. The lowest standard deviation is expected when the greatest percentage is allocated to the risk-free asset. The capital allocation line, CAL, depicts all asset allocation risk-return combinations that result from different percent allocations to the risk-free asset and to the risky asset. The slope of the capital allocation line depicts the reward to variability ratio. The reward to variability ratio describes the amount of extra risk, i.e., expected return minus the risk-free rate, for each unit of additional risk, i.e., standard deviation. Consider the graphic on this chart for a moment. You see that the capital allocation line starts at the risk-free rate and then slopes upward. You would expect this because in order to hold risky assets, the market would demand a higher expected return than automatically received by just holding the risk-free asset. The slope of the line explains how much more return the market demands over the risk-free rate. So, if the slope is 1.5 or 3 over 2, it implies that the market demands 3 additional units of return for holding 2 additional units of risk. The formula for the capital allocation line is the return of the portfolio, R sub P, equals the risk-free rate, R sub F, plus the standard deviation of the portfolio times the reward to variability ratio. Let's focus on this for a moment. In the formula, standard deviation, sigma, is used to measure the risk of the market and of the portfolio. The risk-free rate is the base rate an investor expects to receive, and the investor is entitled to a market risk premium, R sub M minus R sub F, above the risk-free rate for holding a risky asset. The reward to variability ratio is described by the market risk premium, R sub M minus R sub F, divided by sigma M, or the standard deviation of the market. Now that the capital allocation line has been defined by the market, the question to the individual investor is where along the line they want to be. Question: how does the investor decide what portfolio allocation along the CML is best? Which risk-return combination does the investor prefer? You could apply the concept of utility score. Calculate the utility score for each of the risk-return combinations along the CML, and then select the risky allocation that produces the highest score. For example, the utility function might be E sub R minus 0.005 A variance. Or you could plot the indifference curve for different categories of investors and find the point of intersection for the curve and the CML line. Note that the indifference curves just graphically represent the utility function. If you calculate the utility, R minus 0.005 times the aversion index A times the variance, for each of the risk-return points on the CML, you could plot the utility curve. The highest point of the curve reveals the best allocation. Let's look at an example. The table on this slide shows the different utility scores at different weightings of the risky and risk-free asset for an investor with an aversion of 4. Notice how the score peaks at the 80-20 level. Note that the higher the A, i.e. risk aversion, the more risk averse the person is. An investor with a higher risk aversion requires a greater amount of additional return in order to assume a higher level of risk. On the last slide, you saw that the utility function peaked at the 80-20 risky, risk-free allocation level. The optimum allocation percentage is actually somewhere between 80-20 and 90-10. The exact allocation to the risky asset can be calculated with the following formula. The expected return of the risky asset minus the risk-free rate divided by 0.01 times the level of risk aversion A times the variance of the risky asset. Inputting the data, the numerator becomes 9.9 minus 3.8. The denominator becomes 0.01 times 4 times 13.442, which equals an 84.4% allocation to the risky asset. That means 15.6% goes to the risk-free asset. Utility for most investors is very different. Risk tolerance is not just a matter of personal preference, but, as proposed by Bernoulli when solving the St. Petersburg paradox, a function of wealth. The diminishing marginal utility of wealth, as seen on a log scale, is depicted below. Notice on this graphic that the utility of additional wealth increases but at a lesser rate. Do you think that helps to explain why very wealthy individuals tend to invest a large percentage of their wealth in risk-free assets? The indifference curve graphically depicts unique preferences for individual in terms of risk and reward. Utility theory provides the foundation of this approach. Each curve shows the different risk-return combinations that are equally acceptable to the investor. The person could then apply their indifference curve to a chart with the capital allocation line. The intersection point of the curve with the capital allocation line depicts your best risk-return combination. Let's examine the link between indifference curves and utility. In our prior example, we used the formula utility equals ER minus 0.005 times A times variance. You discovered that the utility of a 100% risk-free portfolio was equal to the risk-free rate. In our example, 3.8%. Knowing the utility of the risk-free portfolio, the risk aversion of the investor A, and the level of risk sigma, you can solve for the return which gives the same utility, i.e. the certainty equivalent. The rearranged formula is the required return ER would equal the utility plus 0.005 times A times variance. When you use this formula, ER equals utility plus 0.005 times A times variance, you can quickly solve for the certainly equivalent return. Take a look at the table on this slide for the values. Note, every portfolio along the indifference curve for the same risk aversion A has the same utility, and the risk-averse investor is indifferent between the portfolios. The shape of the indifference curve depends on the level of risk aversion. As previously discussed, the higher the A, the more risk-averse the person. As depicted on this graphic, the moderate risk tolerance individual, A3, demands less additional return for additional risk than the conservative investor, with an A of 4 or 5. So their indifference curve is less steep. What would the curve of A1 look like? In this lesson, you learned about the importance of the capital allocation decision, a risky portfolio consisting of several risky assets, the capital allocation line and reward to variability ratio, and the application of utility scores and indifference curve data.